Hi, I'm Christine Benz from Morningstar.com. The Department of Labor's new fiduciary rule has major implications for the financial services industry. Joining me to discuss some of the big winners and losers with the new rule is Michael Kitces. He's a financial planning expert. Michael, thank you so much for being here.
Thanks. Great to be here.
You have written a lot about the fiduciary rule, but I'd like to talk about when you look across the financial services landscape, what types of advisors, what types of firms do you expect will be the biggest beneficiaries of this new rule?
So in the near term, I think the biggest beneficiaries are simply those that have the least amount of change to actually go through. This would classically be advisors that were already operating as fiduciaries, so generally the registered investment advisor community or some of the hybrids, particularly those who are already tilted more towards doing financial planning and holistic advice. So they were already doing almost everything the rule requires. There may be a little bit of paperwork and compliance adjustments, but not a lot of change to go through. So they can continue moving forward doing what they were already doing, while much of the rest of the industry is frankly going to be a little distracted for the next couple of years, just figuring out how to retool their systems, their compliance, their structures, even their entire business models to fit this new fiduciary landscape.
So the commission-based people would be at the other side of the ledger where they'd be doing a little bit of scrambling in this environment.
Yeah, and it depends a lot on just the nature of the company and how they're structured. But in general, this is much more of a transition for broker-dealers and insurance companies because functionally, insurance companies manufacture and distribute product. Some broker-dealers manufacture and distribute product. The rest of the broker-dealers were at least intermediaries for the distribution of products. And the whole nature of applying a fiduciary duty says, no, you're not in the distribution business anymore. You're in the advice business. If you want to hold out to consumers as advisors and give them advice about retirement accounts, you're in the advice business. And for a lot of these companies, just transitioning from a product distribution company to an advice company is a big shift. It changes your business model because you're not necessarily getting paid to sell your products in the same way anymore. It changes the compliance and oversight of your advisors. It changes how much they need to be trained and educated to actually give good advice. Can't just train them on one product now. They actually need to know more holistic advice. And so I don't know that it's necessarily a death knell for those companies, but just there's a lot of change for them to go through in the next couple of years. Some will probably navigate that better than others, but relative to where they stand right now, the RIAs at least are a little bit better positioned because they can continue business as usual while everybody else is distracted with the transition.
Some firms were probably anticipating this change. I remember when I went through the CFP program probably 10 years ago, I remember there were a lot of commission-based brokers in the program. So it seems like some firms were a bit ahead of this, at least on the credentialing side. Yeah,
some firms have been ahead on the credentialing side. Some firms really were ahead even on the nature of their business models. When we look broadly at the broker-dealer community, many still earn the majority of their revenues off of commissions and revenue sharing from the distribution of products. But the growth of fee-based business has been underway for 15 years. In fact, a version of this was tried back in the late 1990s when the SEC put forth an exemption for broker-dealers to make it easier for them to do fee-based accounts. The rule ultimately got struck down in the courts. That led to the kind of the spawning of a huge growth in hybrid broker-dealer RIAs. But the shift to fee-based has actually already been underway. And in general, the more fee-based the firm is, the easier it is to comply with the Department of Labor's fiduciary rule. If you're purely a fee-based firm, there's even a streamlined version of the rule called the level fee fiduciary exemption that makes it even easier to manage the compliance obligations. So the more fee-based the firm had shifted already, the easier this transition will be. The further the way they were from that and the more commission-driven they were, the more retooling they're going to have to deal with.
Okay, so let's talk about products, big winners and losers. An obvious one that occurs to me would be purveyors of low-cost, plain vanilla index funds. They've been seeing a big uptake of their products. One would expect that those would look even better under a fiduciary regime.
Certainly. I mean, in general, anything low-cost looks good. The low-cost index funds look good. Now, the fiduciary rule is not purely a cost issue. It was often categorized as, well, advisors now have this sort of obligation where you have to find like the one cheapest thing on the entire planet. You can only use that with clients. That's not what it says. I mean, technically what the rule says is you have to give prudent advice for reasonable compensation. Prudent advice means similar to what other experts would have recommended, and reasonable compensation means what other similar advisors would have been compensated for similar advice. So it's actually more of, did you do what other advisors would have done if they didn't have any compensation incentives beyond just getting paid normally for their advice. And that doesn't unequivocally force you to the lowest cost provider. The biggest thing that those rules actually scrutinize is companies and products and solutions that are disproportionately expensive or of disproportionately inferior performance. So it's not necessarily a pure tailwind for the lowest cost, but it is a massive headwind for anything that was high cost, and just the redistribution of that means once you're reassessing, a lot of low-cost providers are going to benefit. More generally, the challenge is just companies that had products that, frankly, were not necessarily the best in performance or outcomes, but they paid pretty well, and they had a lot of wholesalers who built great relationships with advisors, and they got sold on that basis.
And certainly the house brand of mutual funds.
Right, and some house brand mutual funds. Now, again, it depends on your house brand.
Right, some are better than others.
If you're the House of Vanguard, you've still got a pretty low-cost option. If you were a couple of other houses, it maybe didn't look as good. More scrutiny on those products to say, well, just do they really stand up on performance at the end of the day? And obviously cost is a driver of performance, not the only, but a major one. So there's just more scrutiny on really performance, where cost is a drag on performance. It indirectly becomes a focus on cost. But the biggest losers in this are just simply products that didn't have great performance and results in the first place, that were relying on wholesalers and commissions to incentivize salespeople to sell them. And that's not on the table anymore, or at least it's going to be drastically harder, because the advisors and their firms are going to say, wait, I don't want to get sued because we put your mediocre product on our platform. Like, come to us with a good product that's got good performance and reasonable cost, then we'll put it in the mix. And that's a huge change in just the incentives for product companies, right? It's not, we got to figure out how to make a product with the best commissions so that we can get the most people to sell it. It's, we have to make a product that's actually really good so a fiduciary advisor wants to use it.
Right. Let's discuss annuities within this landscape.
So certainly annuities are a product line that's had a lot of challenges from regulators, from the media around, unfortunately, having a history of at least a subset that were pretty high cost, not so great results, a lot of opacity, and a lot of complexity that created problems. There's been a discussion that, well, with all the pressures of fiduciary against high cost, against complexity, it's like a death knell for annuities, particularly variable and equity indexed annuities. I really don't think that's the case. I actually think there's a potential that we see kind of a renaissance of the fixed index annuities and the variable annuities coming through this, because the products aren't fundamentally bad. I mean, they're tools to use that fit certain situations. The problem was, for many of the companies, they had, I think, gone down the slippery slope of saying, well, we don't have the best product, but at least if we give some good commissions, a couple of people will sell it. Then those got sold. Then you were a high commission product that wasn't great, then you were getting sold, and the media took some justified swipes. When we come back, if you come back as a company and say, all right, we can't pay much of a commission anymore. We could maybe pay a little. It's not completely forbidden, but we can't pay much of a commission. We have to actually compete on merit, and so does everybody else. So you're not going to be the merit product competing against other high commission products. You're going to be the merit product competing against everybody else's merit product, and the meritocracy says who wins. That's actually a huge incentive for annuity companies to just try to flat out make the best product. And I think that means we might actually see some new, innovative, creative, good products. The sad reality, as someone that's followed the landscape, I've written a number of books about annuities. I've watched this dynamic play out where companies that tried to make good products got outsold by companies that made high commission products. Just people went where the dollars were, or salespeople went where the dollars were. When we rearrange the landscape and say everybody has to compete on the same meritocracy platform, I think there's actually a new opportunity for creativity, good creativity, that makes new annuity products that we'll actually want to use going forward. So it's maybe going to be a tough transition, We'll almost certainly see annuity sales drop in the next couple of years as all of this changes. But I think within 5 years, we may see a renaissance in the world of annuities and actually start talking about them as good, viable products for retirement again.
Okay, Michael, always great to hear your perspective. Thank you so much for being here.
My pleasure. Thanks for having me.
Thanks for watching. I'm Christine Benz from Morningstar.com.